Okay, thank you for joining us, everyone that's on the call. My name is Daniel Medina with Investors Advantage, and I'm going to bring to you John Grace, the founder and president. For those of you who aren't familiar with us, we're a financial planning and money management firm located in Westlake Village. We've been in Westlake for the last 30 years, and the company was established in 1979. We're proud to do these kinds of things every week, and John Grace, you're on.
Thanks, Daniel. And Daniel's been with us for, geez, what is it, going on 14 years now, right? So time flies when you're having fun. And we have Jasmine Alvarado, who helps us keep things in order, joined us about 6-7 months ago. And so we're ready to rock and roll. And by the way, to that point, in terms of what's going on right now, everybody's calling it unprecedented. We can call it that. And, certainly there have been a whole lot of surprises. And I have to tell you, I don't think this is the end. This is just the beginning. We'll get into that. But we've been preparing for something like this since 1999. I'm aware of maybe 2 offices in the Conejo Valley where there may be 2,000 to 3,000 financial advisors who pay for independent research. We, of course, are one of those offices. And it was not cheap. It was up to $10,000 a year for several years. And I have to tell you, when you're paying that kind of money for information, you read it. You read it at 3 o'clock in the afternoon. You read it at 3 o'clock in the morning, particularly when it's information that's objective and completely independent. The trouble I have with my peers, being in the business since 1979, is typically the only place we draw information is from our hierarchy. So, and many of us, the companies manufacture insurance products or securities products. And if I manufacture exchange traded funds, for example, what am I going to suggest that you own? 100% exchange traded funds. What else is there? It's the best thing since sliced bread for everybody all the time. And on that note, one of the messages I think we have conveyed to a fault is buy and hold no matter what. We'll touch on that too, because I think that has a place, and I think it is a place, buy and hold, that works some of the time, but not all of the time. And unfortunately, that is about the biggest mantra that we have conveyed to people: buy and hold and hope, sit and take it. And you just have to, bear the pain. Well, I've got good news for you. It doesn't have to be that way. And that's why paying for independent research has been helpful, so that people can see that whatever the market does doesn't mean that's what your account's going to do or has to do. So we're going to look at it from the standpoint of conquering the crash. And I will submit to you that, as I say, this is just the beginning. And in fact, we had a very, very nice day. I was just checking. I think the Dow was up about 500 points today. That's a huge day. But it may be that the market is throwing a head fake. And people are going to get complacent again, which has been something we've been talking about for a long time, as opposed to being prepared for the good, the bad, and the unforeseen. You don't need to predict the future to be prepared for it. So we'll talk about that, and we'll go to our agenda. I think you have that, yeah. So that's our little introduction. We'll be looking at COVID-19. The Fast and the Furious. I mean, you've not seen anything like this, but we have been through some of the things that we're going through right now, just not as quickly, I think. We'll get into our recommendations. And again, buy and hold is not one of them 100% of the time. And then we're going to talk with Holly St. Germain, who is a mortgage broker, someone that we refer business to. So that tells you we think a whole lot about her, and we want her to address what's going on in the industry. And Holly, I know you're here, so we particularly want to make sure you touch on, some of the challenges we're seeing right now in terms of the mortgages and how they're becoming more difficult, even for the well-to-do people, particularly when it comes to taking out cash. So, and then we'll have Q&A, and I believe there's a center button right where you are on your screen. You can submit messages to Daniel, and that way he'll be able to kind of collect the questions, and we'll go through them as we need to, and we'll take as much time as is warranted. So let's dive right in. So yeah, based on the here's one of my favorite quotes. You'll hear 2 of them actually. By failing to prepare, you are preparing to fail. And we're particularly delighted with our trademark, which is the proof is in the planning. All right. There's another quote that I like just as much as this one, and it's from Colonel George Patton. And the way it goes is, if everybody's saying the same thing, somebody isn't thinking. So everybody is thinking the same thing. Somebody isn't thinking. So we see a lot of that in the securities industry, where we all seem to look exactly alike and talk exactly alike, and we tend to be very confusing. We're going to make it as clear as we possibly can, but we also want to look at everything from a majority of perspectives as opposed to, for example, it's going to be a V-shaped recovery. We'll touch on that. I hope it is, but let's be prepared in the event it is not. So yeah, we had a great day today. But at the same time, what's interesting is that the great market gain overshadowed the fact that the economy shrank at an annualized basis for the first time since 2014. And as I say, right now, I think the market might be getting a little ahead of itself. Sometimes the market does what people do, and the market responds the way people believe. And sometimes people, regardless of your preference, we get high on hopium. And sometimes I think that's exactly what happens in the market. If we look back, the highs that look like they were reached so far this year, back on the 19th of February, and then we had the COVID-19 outbreak that became public knowledge. Actually, many of us saw that back in December. I imagine you did as well. Then we saw the massacre in oil markets. That certainly hasn't finished. U.S. Treasury yields plummeted. Interest rates for corporations, skyrocketed. Then we saw the expansive Federal Reserve action. I think that's what the market's really playing on right now, because the fundamentals are not in place. And then the CARES Act. But from peak to trough, or from the 19th through the about the 24th of March, we saw a 24% loss. And what we're saying really clearly is what we want you to recognize is this is what the market did, and this is what I did. That's what we want to have happen as well as we possibly can. In other words, when the market's off significantly, we want you to know what kind of dollars you need to maintain. And if you see to the extent that your dollars are retained or within some kind of a range, we'll talk about that more, then you can breathe and you can play the game. I mean, it's all a game, all right? And it's a game called life and living. And what I want for you, and certainly for myself, is to be able to tell the story as opposed to be, talked about. I want to be on the news, not in the news. So, this devastation we haven't seen before, particularly this quickly, where transportation is just knocked out 88%. Lodging, restaurants, online businesses, sports and recreation places, pet services, all come to a halt. At the same time, this is also something we'll discuss, Great Depression. This pattern seems to be revisiting itself. Food and beverages, places where we can get, some of the services delivered to us, like food, right? Those, a lot of growth happened at the same time. So, when we look at the Great Depression, which people are fearful, recognize first and foremost, on a per capita basis, more Americans became millionaires than any other time in history. So what that suggests to me is there may always be a way to make some money. But if we're fearful of a word called recession or depression, then we don't see the opportunity that might be right behind that door, but we close the door and lock it and make decisions based on fear, as opposed to looking at the facts and deciding, okay, how do I limit my losses to prepare for opportunity? Because there is always opportunity. And yeah, we saw, the 4.8 contraction in the first quarter. Some people are wondering, how's the second quarter going to look? And I'm going to say to you, maybe you're afraid to ask, but I think it's going to get ugly. It's going to get very ugly. This reflects here what we've seen so far in looking at the shutdown in China on January 24th and how the cases have peaked there. Looks like it takes about nearly a month for the peaking to occur, and then almost 2 months for the first day of no new cases. Now, I went back and looked at, the serious Spanish flu. That was like 1918. And the interesting thing is, on average, it looks like it takes about 60 days to kind of clear this thing. But I see 3 spikes with the Spanish flu. And I also see something else that, unlike Los Angeles, San Francisco and Denver opened up sooner. And guess what? They had more cases. And what I saw today is Germany, as you may know, has opened up recently. And unfortunately, they're beginning to see more cases again. So you've got this tug of war going on. Is it the right thing to do? I'm going to err on the side of life. I want you to live. I want to live. I want to be able to tell our stories as opposed to being a statistic. So most economists expect the contraction to only deepen. And if you ask me what my best answer is in terms of how far it might crater in the second economy, I imagine it to be a complete disaster. Now, the way people assess recession, you don't see it in advance. It's only after the fact. And what it takes is 2 quarters back to back so that you are officially in a recession. These numbers are about 30 days old now. And it's funny how 30-day numbers can be ancient. And in fact, we see the second quarter right now, it looks like it's going to be about double this number here of just a month ago. And on that note, let me comment that back in December, I asserted on public TV that the likelihood of a recession I thought was about 30% in December. In January, I made that 80%. Today, no question about it, it's 100%. We're not going to miss that. And we may not miss a greater depression in the cards, but we've got a recession that'll be showing up in short order. So what do we ask people to do? You've been hit with an onslaught of data. And right now, a lot of investors are paying attention to earnings. I don't know how earnings can be really good when there's no spending, all right? And people, along with businesses, don't have much in the way of resources. And so what many of us have been doing, consumers, business owners, and countries, all of the same fashion, so we're all doing the same thing, has been piling on the debt. And the interesting thing is, by the last report I reflected on, it looks like cumulatively, consumers have amassed $2 to $3 trillion more debt today than we did in 2008. And I love the quote that this is an analyst who was with Lehman Brothers. Remember, they just disappeared. They had to shut down. He lost his job after being at Lehman Brothers for 4 years. He really liked the job, did not expect Lehman Brothers to just disappear off the face of the earth. And now he's a writer that I follow. And he says, when we go back to look to see what have investors learned since 2008, his best answer is squat. We've learned squat. I think he's right, so that's why I'm repeating what Brian Sozzi has to say. So what we're saying is nothing like what our peers are saying for the most part. All our peers are saying is sit and take it, hold and hope, stocks for the long haul. We're saying, no, not so much. It's a two-part punch. The first is to be more diversified than you've ever been before. And the best way I can kind of put that in perspective is if you're looking at your 401k, 403b, more corporate retirement plans, for the most part, you may have 1,000 different vehicles to choose from. So it looks like you're diversified if you have 16 different names in your boxes. The truth is you've got a combination of some degree of cash, bonds, or stocks. It's only 3 asset classes. That's it. That's not a whole lot of diversification compared to some of the institutions and the endowments and the foundations. Yale as an example, not to say that it's a template, but what impresses the heck out of us is we count 7 to 8 different asset classes. So, and by the way, their exposure to traditional assets like cash, stocks, and bonds is low. And they have 5 or 6, 7 other vehicles or legs under the stool. We can all agree that having 5, 6, 7 legs under your portfolio stool is going to make for a more substantial stool than 2 or 3 legs. We can all agree to that. And what that also means is that sometimes we have a gain that in one area, we didn't expect it, that might offset or even completely or to some extent, some percentage of the loss elsewhere. That's the beauty of the diversification. And let's please understand, you can't see where you need to be. So that's why we need to be everywhere more than we've ever been before. And then we need to do real planning, not just throwing darts in the dark and going, we made money, I'm so smart. Or, oh, geez, I'm going to cry because we lost money. No, the question is, how much money are you going to need after your last paycheck? We want you to do that math. We can help you do that math. But in talking to the son of one fine client, they put the money in one position that makes them feel good today, but I suspect they do not see what amount of money they need in 20 years or so when they're going to be financially independent, when they intend to be financially independent. We want you to see the target. And then we want you to recognize what it takes to look annually, if not more often, to see, are you on target? Does it look like we're making progress here? Do we need to reduce the amount of risk? Do we need to increase the amount of capitalization, contributions to the account? Do we need to extend the time frame out so that we have more time to collect more money? Or do we need to look with our eyes wide open at our Social Security benefits? What's going to make the best sense for you? And those are all personal answers, so there's no one size fits all. I also will submit, in addition to the 1-2 punch of greater diversification, the next one would be active management. So let me give you a quick example. You might remember the movie Karate Kid, wax on, wax off. So let's just use that as an example of how we might invest. In 2008, most of us held the stock. So that's, we were all in. What you might have wanted to have done or have done for you is for the assets to be moved out of risk from stocks and bonds into cash, so that it's not passive where we still own the same number of shares and we're watching the price drop, the S&P 500 from peak to trough about 57%. On $1 million, that's minus $570,000. That's not fun, right? So what we want to do is limit those losses so that you can feel like you're in the game, because you don't have to throw in the towel or throw a Hail Mary pass just to try to get back to even, because you have discovered what kind of loss is acceptable to you. And that's not cast in concrete, but if you know the loss that you're willing to accept, and then you see that the portfolio is performing within your specific parameters, it gives you a sense that I can stick around, play the game, because while the market's doing this, my account's doing that, and that may help me figure out that I can stick around here. By the way, we do, when we're done, we'll send you a little message to say thanks for joining us. And in there, it has two parts. One is a 2-minute video that we did that shows how this is a real story, a real situation. This is a rocket scientist couple in Seattle with about 1.3 million in his 401k. And we went back to say, geez, if you had that money in 2008 and there was a 57% loss, please notice that your probability of success having that money through age 100 went from, I think it was something like 83% favorable odds to 0 odds. When would you like to know that? So take a look at the video. It's only 2 minutes long. And then if you would, complete the 5 or 6 question little questionnaire in part 2 that we're sending to you, so that you can get a sense for what kind of loss you can accept. Then you want to look at how you can design the portfolio accordingly. And what we've been doing is reaching out to clients. We see that many of our colleagues, we're in Westlake and Thousand Oaks Boulevard seems to be command central for wealth managers. And a lot of us look like we're deer in the headlights. We're not quite sure what to do. We weren't prepared for this, and we don't really know what to say other than buy and hold, which we think is a bad answer. And then review your risk tolerance. And again, you'll get those tools. So I'm going to put it on, let's see, thank you. Well, this is a visual for you. So I asked this question. This house happened to be built 2017. And I did this talk before peers last year. And I pulled up this picture because, as you can see, this house is a survivor. And I thought to my peers, geez, what a wonderful way to kind of ask the question. Are we building portfolios that are, going to survive the worst that could happen? Or are we building portfolios that are going to do just like everybody else? So I asked the question of my peers, about 100 people in the room, what do you attribute this house standing here to? And the 2 answers I got was act of God and divine intervention. And I said, wow, those are good answers, but they're not the correct answers. Anybody else think they have the correct answer? And the last person, the woman, said it was built to last. And that's exactly what the designers and the owners of this home had in mind. And what they said was, we want to build a house in Mexico Beach, Florida. We don't see a hurricane coming, but this area is prone for hurricanes. So we want a beautiful home in a beautiful location, but it's got to be built to withstand 250 mile per hour winds. That's a tall order. Now they found a designer and a contractor who said, nope, we've never done anything like that, but we're intrigued by the challenge. So let's see what we need to do. Instead of putting pylons in the sand, let's not go down 10 feet. Let's go down 40 feet. That might help. Let's put rebarb in the walls, and let's make sure this roof is not only beautiful, but it's flexible. To that point, the doctor, or one of the owners, lives officially in Tennessee. They put a camera upstairs on the house, and he could see the roof flapping like, it's going to be taking off like a eagle any minute now, but it survived. So that's my real point. How can we build portfolios to last like they were successful at building a house to last, no matter what might happen, so you can continue to tell your story. So with that, we're going to ask my good friend, Holly St. Germain, to talk about, mortgage madness, what's going on in the mortgage industry today. Is it true that it's not as easy to get a loan as it was before? And what about being able to cash out? And in fact, I called a couple of clients who we referred to Holly because I want to make sure they get her up-to-date perspective. And we've had the pleasure of working with Holly for some time now. We look forward to continuing to refer business her way. Holly St. Germain,
Hi, John. Thank you so much for having me.
My pleasure. It's all yours.
Right. Yes, it's mortgage madness. It's a great description. So I am a loan officer with Freedom Mortgage. Freedom Mortgage is an independent mortgage banker, which means that we sell directly to Fannie, Freddie, FHA, VA, and USDA. So those are the relationships that we have. We also service our own loans, which with the CARES Act has definitely impacted all lenders who are servicing, and I will go into detail throughout the presentation. So the CARES Act, which stands for the Coronavirus Aid, Relief, and Economic Security Act, was established March 27th, and it provided $2 trillion in economic relief by the government to businesses, workers, families, and lenders. And Daniel, if you want to go on to the next slide, that'd be great. And with the CARES Act, one of the initiatives that came about from this act was the forbearance plan and extending forbearance terms to current mortgage holders. So originally, forbearance plans typically started with 90 days. They are now 180 days are allowed on all government-backed mortgages, FHA, VA, USDA, Fannie, and Freddie. And you can ask for an additional 180-day forbearance on request. So 12 months of forbearance can be requested. Each servicer will respond differently. So the one takeaway is, what's the difference between the lender and the servicer? So the person that you may have received your mortgage loan through may not necessarily be the servicer. The servicer is the individual or the company that's on the statement you make your payments to. So if you are in the need of requesting forbearance, you would want to reach out to the servicer and the number on your statement to start that process. There are some loans that are not backed by the government, so they're going to have different forbearance plans. And you can go on to the next slide. Oops, back one. So what is a forbearance? What is the terminology? So a forbearance is just a temporary pause. It doesn't mean that the payments go away. You don't have to make your payments. Those payments will be made up in some form. So just recent announcement about 2 days ago that Fannie and Freddie now has removed the requirement of having a lump sum after that initial forbearance period is made. So typically it was 90 days for the initial forbearance. And after that 90 days, the consumer had to make a lump sum payment or ask for different payment plans. But now it's no longer a lump sum, and the payment plan should either be in some form of loan modification, extended to the end of the loan term, or you do have the option of making a lump sum after that period is over. So just always reach out.
Sorry,
go ahead.
Let me interrupt you just for a second here, because for the most part, I believe the folks on this call are primarily in California, which of course means with higher limits than typically the loans provide for with Freddie and Fannie. So I want to make sure people understand, that you know, it is a loan, and some lenders will require that loan to that temporary, 90-day forbearance, is a window that you don't have to pay, to be paid in a lump sum. So I think you can take it from there, but I want to make sure people recognize how it might work here versus elsewhere.
Correct. And thank you for interjecting on that. So it's always in your best interest to make the payments, even if it's a partial payment. Even though the government is promoting, and you're seeing on the news and bombarded by all the media of taking advantage of a forbearance plan, if you truly do not need it, the recommendation is not to take it, and make arrangements, even if it's a partial payment, to preserve your credit down the road and retain your current mortgage payment plan. And we can go on to the next. So the impact on loan programs and guidelines. So the rate environment has become very volatile. And the reason being is because of the CARES Act and what the impact is on the servicers and having to make those payments. Someone has to make those payments when the consumer decides to choose forbearance. So initially, the servicer is making those payments for the initial 90 days or however long that forbearance term is, and that's a lump sum of money. So I think there was a stat yesterday, just for freedom, we are getting 30,000 applicants a day for forbearance. That's a huge number. So take 30,000 times 90 days, and the amount of mortgage payments each person has to make, that servicer has to cover that amount of money before Fannie, Freddie, VA, FHA, or USDA step in to assist with that forbearance payment period. So based on those servicing guidelines, the impact is now going to higher rates and impacting on loan programs and what the availability is. So it's becoming riskier on the loan applicants, especially if they're self-employed, if they're a higher loan amount, less money down, if they have mortgage insurance, if they have a lower credit score. So all of these guidelines are changing, and they're changing on a daily basis. I mean, they have one guideline today and it could change tomorrow just based on risk tolerance. So just be aware that that is the reason. And when we're asking for verification of employment, and it's very pertinent now with customers that are maybe being furloughed, who are losing their jobs, or they do a refinance now and then 30 days they lose their job and go into forbearance. Those are all factors that are impacting rates and loan program in the environment today. So what are some alternatives that are making it a little bit easier because of the stay-at-home order? Fannie and Freddie and also FHA and VA are allowing appraisal alternatives. So the appraiser may not necessarily have to go visit the home. They may be able to do some virtual walkthroughs. They can use some drive-by and different methods for evaluation of each of the homes. Regarding signing loan documents and limiting the one-on-one contact, remote online notaries are being accepted. California is one exception of a state that does not allow the online. But if you go to the link that's on the slide, there's a lot of states that do offer that, so that will help ensure everybody's safety. You can go on to the next slide. In regards to verifying employment, since most companies have their employees working from home, including their HR department, verifying someone's employment has become a little difficult and challenging to get phone calls returned in a timely manner, as well as written verification. So for Freddie and Fannie, they're allowing documentation provided by the borrower, pay stubs, maybe bank statements to show that they made a deposit from their employer within the week of closing. So there are alternative ways to verify someone that they are currently still employed in this environment and able to close the loan. Every lender is doing verifications almost within 1 to 2 days of signing loan documents to ensure that the customer still has the ability to repay that loan. FHA does not require any verifications when you're doing refinances from FHA to FHA or VA to VA. So that definitely helps expedite the process if you were in need of refinancing and have either an FHA or a VA loan. Next slide. So best practices is just continue to adhere to all the CARES Act, pay attention to any changes. For the consumer, if you have questions, the CFPB, Consumer Financial Bureau, is a good site to go to get the most accurate and up-to-date information pertaining to the CARES Act, as well as to lending guidelines. Everyone's limiting in-person situations, working remotely, so just if you're in the process of purchasing and closing on a new home purchase or in a refinance situation, just be patient because the timelines on turn times have been extended to accommodate everybody working remotely. Next slide. And that's pretty much it for me. If anybody has any questions.
Thank you, Holly. That's really helpful. What questions do we have so far, Daniel?
So first question's for you, John. What are the chances of a V-shaped recovery?
Well, okay. So I'm going to say that's certainly what we all want to see. And as I say, you know, we can't think along the same lines everybody else is thinking. We've got to look at the whole enchilada. So it could be U-shaped. It could be W-shaped. It could be swoosh-shaped, all right? But it also could be L-shaped. And that one's, to me, is the most interesting, primarily because we've been in an L-shaped recovery in history twice. Right after the Great Depression, stocks took about 25 years to get back to even. And that's assuming, one, you didn't sell any shares, and two, you didn't take out any money. 25 years. New York real estate, at the same time, after the Great Depression, took about 40 years to get back to even. And let's understand that if you were an adult in the early 1900s, life expectancy was typically mid-50s. So that suggests that if you had any money and you're an adult, 25 years to get back to even in stocks, 40 years to get back to even in real estate, you were probably long dead before any of those came back. And by the way, that's probably my biggest driver. It's like I have to imagine folks in those positions really just died with regret. That would not be my idea of fun. Now, so that would be an L-shaped recovery for the US. And then more recently, you remember late 80s, 88, 89, we were all convinced Japan was going to be #1 in gross domestic product. We were fine with that. It seems like both their stock market and their real estate market just peaked on exactly the same day, or right around then, into the year 1989. So here's the trick question. And remember I said it was a trick question. Since 1990 or so, we see that the stock market in Japan dropped about 80%. The real estate market in Japan dropped about 70%. Which one got back to even? Remember I said it was a trick question. And the reason is, you don't need to know the answer. I was trying to give you a clue. Neither of the above are accurate or the correct answer. So it would be D, neither of the above. Neither the stock market nor the Japanese real estate market have gotten back to their high water marks of about 30 years ago. That's kind of, that's really quite surprising. And it would be hard for us to kind of wrap our minds around that. Now, let me just say one more thing, and that is, this is something I also think that people should be keeping in mind because we all want the economy to grow 4, 5, 6%. But here's the thing, globally, we now have more people 65 and older than 5 and younger. That's never happened before. So, you know, if you're in your 60s or 70s, you might have a pair of the old PF Flyers and maybe you're lacing them up, but it's not about jumping higher and running faster anymore. It's about, let me find my way to the couch. So I'm just saying, you know, without having a whole bunch of young people in the equation, there's not a whole bunch of reason to believe that the economy is just going to soar.
Excellent. Thank you, John. Next question is for Holly. I believe you covered this, but how does the forbearance look on your credit?
Great question. So right now, any of the servicers cannot report any delinquency to the credit bureaus as negative as long as the customer was current up until the time of forbearance. If they were past due and then requested forbearance, it would still report negatively. But because of COVID-19, none of the servicers can report negatively on the credit report. So that is very good news for consumers.
And Holly, let me ask you, relative to being able to cash out, is that still possible?
Yes. It is. It's very limited. Yeah. We are still doing cash out. There are a lot of secondary, like other institutions, lenders that are no longer doing those. even equity lines of credit are being shut down. And we saw that back, in 2008, 9, and 10. So the accessibility to tap into someone's equity is definitely being restricted. And I think that's going to continue on going forward. But we are still doing cash out refinances. Some of right now the max LTVs that I have seen, LTV being loan to value, is 85%. So they're definitely starting to be more restrictive on what the max loan to value can be. VA and FHA have not put any additional restrictions on their cash outs.
Okay.
Excellent. Next question for you again, Holly. If you've been furloughed, are you still able to do a refi?
Great question. So if you are furloughed, you would have to wait until you are back at work, where that verification of employment can be verified that you are receiving a paycheck.
Got it. And this is the last question that we're gonna go over because we're running out of time here. But this is my question. I haven't seen any talk on reverse mortgages. Have there been any changes or news about that?
I am not a reverse mortgage specialist, but I actually referred a client to, and I have not seen any negative changes with the reverse because they are FHA loans. So they're following those FHA guidelines, which they're a little bit not as restrictive as what Fannie and Freddie is doing right now.
Sure.
Well, and speaking of, deferment, furloughs, things of that nature, Social Security is going to take a turn, right? I mean, everything is just coming up, it's changing. But I mean, if you're not making any money, you're not making contributions to Social Security, so that's going to affect your Social Security benefits. Huh.
Absolutely. I think we're going to see, when the economy gets back in, we're still going to see the ramifications of all of this later on, because, are people able to return back to work with their jobs? Are they going to have a reduction in pay, a reduction in workforce? We could definitely see some changes with higher foreclosure rates after this is all over, even though the forbearance period is like a Band-Aid right now.
Yeah, well, if you look at 911, right, that was one day, and it impacted so much of what we do here in the U.S. for the next 5 or 6 years, especially when it comes to like travel. This is now worldwide. So it's, as I say, that B shape, yeah, I sure hope so, but I would not take that bet. I would not make that bet. B shape, that would be very ambitious. It'd be a whole lot of hopium is the way I see it.
Absolutely.
So what's coming? What's on deck, Daniel? Who's on next?
We're going to be doing these at least for the next 3 weeks, and likely we'll continue to do those. Next Wednesday, we're going to have Dr. Herman Williams on, and he'll be talking about what the risks really are and what's fiction. There's a lot of news going on right now, and some of it's real, some of it's not. So we'll talk to Mr. Herman Williams about that. After that, we'll have...
I'm sorry, well, let me just jump in here, please. Dr. Williams happens to also be, he is a client, his family is a client. In fact, we have 3 generations with the Williams. So, the country is taking over Dr. Fauci. We can't get a hold of him, but we can get a hold of Dr. Williams to ask him the questions that we would love to ask Dr. Fauci. And one of the ones that I want to ask Dr. Williams is, how come this damn thing is just eating up minority people? Seeing as I'm one of those, I want to know, what can I do about that?
Excellent. On the 13th, we'll be talking about staying healthy at home. And on the 20th, we'll be talking about difficult decisions for aging parents. This is specifically to what programs are available for aging for parents. This is a difficult time, so everything gets more difficult.
Yeah, so we'll be dealing with an expert who helps people walk through that, and there is no best answer. Everybody wants to do the best thing for the parents. It's a flip of the coin. It really is. You don't know what's going to be best. You're just trying to make the best decision you possibly can.
Excellent. We want to thank everyone that joined us. We'll be sending a follow-up email, and please feel free to join us next Wednesday. Have a great day, everybody.
Bye-bye. Thank you.
Thanks, Holly.
You're welcome.